Let me just welcome all of you to this tax update. It seems like the numbers are trickling in still, but we can start slowly and just do some of the early parts. So this presentation is going to be a joint presentation between myself, Paul Gearing, tax partner in Durban, and Kabashni Woodley, the other tax partner in Durban. We've got two parts to the update. You're welcome to ask some questions in the chat box, and we will see how we can answer some of those questions during the course of the presentation. So, as always with our presentations, we start with our general disclaimer. This is not formal advice. This is a broad presentation on some of the issues that are affecting us during these times. And advice is taken in more formal sittings, not necessarily in the office anymore, sometimes by Zoom, sometimes by Teams, sometimes on a WhatsApp call, but advice is a far more formal process than a presentation. We're in the midst of COVID. Hopefully we're starting to get to the peak, and we'll plateau and soon get back to some form of normality. But we mustn't forget that we are in this period. It's not too many days since we had the International Mandela Day. This morning, the last of the Rivonia trialists passed away, an end of an era of people who truly dedicated themselves to South Africa and its people, and not to their own back pocket. And maybe one should give some thought to making a donation to the Solidarity Fund at this time. You're coming on to a free webinar. You're going to get some possible interesting insights, and maybe one way to repay that is a contribution to the Solidarity Fund. The SARS computer, we've seen all the sort of WhatsApp jokes about the people who are running that computer, but in truth, they do have quite a powerful computer system. They're interacting with the banks, they're interacting with the medical aids, the pension funds, provident funds, retirement annuity funds, and they're gathering a lot of information. They have done that primarily to pre-populate tax returns and to get that process simplified, as they call it in broad terms, but they also are using this to gather information about transactions that flow through your bank accounts. This is an example of a query that a client received for verification, and the question is not the amount of interest that they received on their various bank accounts, but the flows of money into their bank accounts were then compared to their taxable income disclosed in their return. So if you transfer money from your one bank account to your other bank account, and then back again, and then back again, you're going to cause some questions for yourself potentially if SARS does one of these verifications looking at all the credits in your bank account. And you'll have to prove laboriously all of the transfers between the various accounts. And as usual, you get a 5-day window period to respond. And if you don't respond, there generally will be repercussions. So it's something to consider going forward, how one manages these bank accounts. And for people who do multiple transactions with multiple bank accounts, they need to be aware that there are possible queries that can be raised. Now, SARS does more than just this. They have also started looking at companies, and where companies have not lodged tax returns for a number of years, they are raising estimated assessments based on the VAT disclosures of those companies. And once again, you'll be given a short duration to justify why that estimated assessment ought not to be raised. So there are risks in not submitting your returns timeously, which gives rise to these estimated assessments, and risks when there are bank accounts where there are entries in those bank accounts that you had hoped to keep a little quieter. These computer systems, we all know the terms about big data and all of those good things. SARS has got big computers. They have access to people who can do analysis of the information, give you queries, and put you in a difficult position. Now, we all in the profession are having problems with SARS in this period. There's uncertainty as to what is happening. There have been delays in the filing season, and many people have been quite happy about those delays because generally they aren't lodging their returns in June, July, and August. They're lodging them later in the year, so it hasn't impacted them too much. But the uncertainty as to when the return will be issued, will there be changes on the return? When will the trust and the company return be issued? It's holding up people's immigration when they need to lodge their final tax returns. And there are queries that we all, as the profession, are having with SARS. A new phenomenon is coming through the auto assessment process. And our PKF Octagon office, part of the broad PKF family, issued a newsletter which went out to many of you on all of the email addresses that we circulate our newsletters to, and highlighted this auto assessment process. And our big concern with that process is distributions from trusts and capital gains where an IT3 certificate has not been issued. And if these amounts, which are known to taxpayers, are omitted from that auto assessment, there is a risk of penalties being imposed later. So we must enter into this auto assessment process with care and with open eyes, not to be caught unawares. We'll deal with a little bit more later the whole issue of the PAYE and the provisional tax deferral relief, but there is contradictory information that's being issued by SARS at the moment, and there isn't clarity on exactly how automated the process will be, which is giving us a lot of concern. Now, the Ombud is the person who looks over the shoulder of the commissioner to make sure that what he is doing is in terms of the law. And every year he issues a report, and this is the second report of a systemic investigation. Now, systemic investigations are when we, the profession, raise issues with the Ombud of problems that not only affect one taxpayer, but affect a number of taxpayers, and where SARS continually makes the same mistakes. And one of those key issues is the PAYE return, PAYE statement, and the journal entries that SARS is passing in the PAYE system. So you have a credit and you think you're going to get a refund of some overpaid PAYE, and suddenly the system generates a journal entry to make that credit go away. Now, that's a problem because that ought to be done by an assessment where you have the ability to object to the decision of SARS. You can't object to a journal. And the Ombud has come down fairly hard on SARS in the last while about these and about some of the complaints that arise from that. So it's something to be very concerned about and something to always watch. We recommend that whenever you're rendering a return to SARS, be it a VAT return, be it your PAYE return, that you get a statement of account printed out before and after to ensure that your liability to SARS is what you believe it to be. Because these journal entries get raised without a notification. And so you can miss that journal entry and then out of time not be able to deal with the problem. The issue of time is also an important issue with SARS at the moment, and they are bad. Unfortunately, we are also bad at adhering to the time rules in the dispute resolution process. There's pressure on them to get their timing right, and when that happens, there'll be significant pressure on us to make sure that we adhere to the time frames. So it's important to monitor your e-filing profile, monitor assessments to ensure that one deals with those disputes in a timely and proper manner. Generally, the matters are getting more complicated in dealing with SARS, and you ought to be taking the necessary professional advice. So on to some of the relief measures that were issued, and this is just to make sure that we are in fact dealing with those relief measures. So the employment tax incentive was established a number of years ago and dealt primarily with those people starting work in your company aged 18 to 29 and earning less than 6,500 Rand a month. Now, for a limited period, for 1 April to 31 July, that ETI was increased both in terms of the amount available and the age brackets that were covered. So it covers all employees up to 65, earning less than 6,500 Rand per month. Now, just to see that everybody is still awake, we're going to just run a quick poll on the employment tax incentive. So we're up to 409 people on the webinar at the moment. Some are still coming through the waiting room, and we're just waiting. About half of the people have voted so far. And it's a little sad to see that more than half of the people have not made use of this ETI benefit. Now, hopefully they will think about this afterwards and analyze their staff complement to see whether some of their staff are earning less than 6,500 Rand a month, and if so, to look at registering. It's important to do this urgently. So the final polls would be 40% have claimed, 48% have not claimed, and 11% are in the unsure range, which is not a very good place to be. So it's important that you look at this, because at the end of August, one does the reconciliation, the half-yearly reconciliation, and if one has not claimed the ETI before then, it will be forfeited. So it's important for those 50% of the audience to give consideration to this if it's applicable. Now, the deferral relief that's available both for PAYE and for provisional tax revolves around one single definition of a qualifying taxpayer. And this would be a company, a trust, a partnership, or an individual. So all the avenues are covered, and generally in tax, as you're aware, when we use the term company, we're also referring to a closed corporation. Now, as long as that entity is carrying on a trade, which is a very broad concept. Now, there's a limitation. SARS could not allow, and National Treasury could not allow this deferral relief to be applicable to every taxpayer, and so they put in some limitations. The first limitation they're working on is the limitation of gross income. Now, initially, they worked on a 50 million level of gross income, and then they relaxed that ultimately to 100 million rands worth of gross income for the 12 months of the 2021 tax year. So for a February company, that's 12 months to the 28th of February 2021, your gross income cannot exceed 100 million. Now, gross income is not turnover, because gross income would also include some of those things that the accountants don't classify as turnover. Gross income would also include dividends, which are exempt, rental, interest, and other amounts received which might be set off against an expense which in accounting terms did not qualify as turnover, but still would be a gross receipt of that company. So it's not an easy number to put your finger on, but as long as you're far under the 100 million, which is quite a substantial level of gross income, you would qualify for this. Now, the other problem one has is if you've got too much passive income. Passive income would be foreign dividends, local dividends, rental, annuities, interest, or remuneration. And if that constitutes 20% of your gross income, then you don't qualify for this deferral relief. So that is an important number to watch out for, because that can exclude you. Now, if your company solely does rental income from fixed property, then you would qualify. There's a special carve out for that section, but it's important to look at those other amounts that would be excluded, be they interest or dividends or remuneration. So the remuneration carve out would generally take out all people who are earning salaries, who are getting annuities from retirement funds. That would probably be in excess of 20% of their gross income. And so they would be taken out of this qualifying taxpayer position. Now, in tax, a partnership doesn't really exist. It's taxed as the individual partners. But for PAYE purposes, a partnership is recognized. And for VAT purposes, a partnership is recognized as a separate entity for tax purposes, but not for income tax purposes. And yet, when they've done this restriction on who qualifies, the 100 million threshold of gross income is applicable to the partnership as a whole, because that's how they initially worded it for the purposes of the PAYE deferral relief, but that's also carried through to the income tax relief. So if you're a partner in a partnership and the partnership has a total gross income of over 100 million, even though you might only be a 10% partner with, let's say, 10 million rands gross income, you will not qualify for the deferral relief because it's based on the aggregate of the partnership's turnover in total. One of the key things is tax compliance. Now, tax compliance is your status with SARS. Are you green or are you red? And if you are not green at the time that you render these returns, then you have a problem. You would not qualify. Now, it's not automated that you don't qualify. It's going to come and bite you later that you didn't qualify. And so those who are going to make use of this deferral relief, we need to make sure that you've got a screenshot of your tax compliance status prior to, the moment prior to you lodging that return, so that one's got evidence that you were compliant, because your compliance status is a perpetually changing screenshot at SARS. And so the only way you will have the evidence is by having a pictured screenshot of that compliance status at the moment before you lodge your return. Otherwise, it's going to be a messy, messy position to prove that you were or you weren't compliant. So for us, the main issue is, do you qualify for the deferral relief? As in, are you a company, a trust, a partnership, or individual who meets the criteria? But going forward from that, it's important to rather focus on the estimate of your taxable income, because that is the key number that's going to drive your final tax liability. And we'll look at that in a little more detail. So let's have another one of these polls, a poll on your tax compliant status. So we had about 270 people have answered. It's moving up nice and quickly. It's only a yes, no, so it's not that difficult a question. The answer has difficult consequences, but the question, they say, is a simple question. So majority of you have checked your compliance status, but this is as close as the Brexit poll, 51-49, it's getting closer than the Brexit poll. So it's important to check your compliance status and have that confirmed on a regular basis. So now the PAYE deferral relief was there for the months of April, May, June, and July, those returns. So we're in the last return that's going to be applicable for the PAYE deferral relief. So for those who have claimed the relief, hopefully you've maintained the necessary records of your tax compliance status. Hopefully you did qualify, and some of that will only be ascertained at a later stage, whether or not you do meet the 100 million rand turnover or gross income threshold, and whether or not you erred on having too much passive income. That test will really only be done at the end of the year, and so there might be some unscrambling of the eggs happening. But your repayments will start soon, and hopefully your business has picked up that you'll be able to deal with the cash flows that will occur later when the deferrals come back to roost, because the PAYE didn't go away, it was mainly deferred. And for provisional tax, we're coming up to the first payment for the February 2021 tax year. And this is where you could benefit from that deferral, reducing you to 15% of the total estimate as opposed to half of the total estimate. Now, for me, the most critical thing to look at is the actual estimate itself. Generally and historically, this first provisional payment we would have based on the basic amount. That's your last assessed taxable income, and escalated if it was too many years ago. And that's what we would have done, and we would have felt safe in using that basic amount. And we would have known that there was a possibility of a question from SARS, but it would be a question that we'd be prepared to answer. Now we need to be very careful, almost as careful as we are in the second provisional tax payment, where we need to have an estimate of within 80% if we're over R1 million. But this estimate now, all we need to meet for this test is that under the circumstances that we find ourselves in this pandemic, having lost the month of April, having lost part of the month of May, having to close from time to time, having to limit our staff's access to premises to minimize the risk of COVID, all of those factors taken into account, can we justify our basic amount dropping below where we would have normally put it at the basic amount. And so I say, focus on your estimated tax liability for the year ending 2021 February. Base it on where you are till June or July if your processing is up to date. I'm sure that you're in a far worse position this year than you were last year. Even if you are one of the retailers, you're not selling any alcohol, you're not selling any cigarettes. That's another poll that we could do, but we didn't really want to put that in writing. What are you prepared to pay for a pack of cigarettes? And should they not have increased the excise by double or triple or 4 times to allow the government to at least make some money while you were enjoying your cigarette or your tot? But that's a different poll. What we must focus on now is the estimated tax liability that you will have and your estimated taxable income. And I'm sure that that relief is far better. If you do that estimate correctly and focus on that estimate, you will have far better position than using the 15% of the liability, and you will have no risks with that. Whereas on this, you have the risk that SARS is going to question whether or not you met the criteria or you didn't meet the criteria. There's concerns that it's not an automated, immediate process to allow the deferral to take place, that there might be interventions, and that you might for a period of time be tax non-compliant, which could impact on other forms of your business life. So that is what we would recommend. Focus on the estimate rather than focusing on the deferral. Now, in the supplementary budget or the special budget or the emergency budget, we had no immediate tax changes, but there are concerns that we will be having tax changes going forward. And the minister made mention that he's looking to raise 40 billion rand over the next 4 years to help stabilize the debt. And one of the things that he touched on was the Davis Tax Committee and its recommendation on a wealth tax. There were people who thought this would be mentioned in that supplementary budget as a real announcement of the introduction of this sort of a tax. It came through in very quietish terms in the subtext of the special budget, but it is there, and it's something we do need to consider. Equally, we need to consider the changes that have taken place in estate duty and the further changes that are being considered for estate duty and donations tax. So at the moment, the estate of the first dying can be left to the spouse without any estate duty, and spouses can make donations between each other without any donations tax implications. But the talk is that this will go, that you will no longer have inter-spousal donations or estates without estate duty, and that you will have greater relief of the abatement, the free amount that you can bequeath later, but without the interspousal relief. So it's important to make sure that you are reducing your own estate and ensuring that your spouse has an estate, so that if this does come through, you've made use of the current interspousal donations without donations tax to ensure that your spouse has an estate that she can or he can have exemption on death from a portion of that estate. And that's important to look at. So we'll run the last poll of my session on this issue of donations tax and see what is the views. So this was a slightly harder question, and that's why it's taking a little longer. And there's a lot of opportunity for people to give proper consideration to this going forward. The majority have not made effective use. So the problem is, if the law changes quickly, then you will not have enough asset base in your spouse's estate, and then things will get a little messy going on. And this is the last slide of this first session. These are the tax relief measures. So it's about 56% of you have not thought properly of these use of donations. So that needs to be dealt with. You need to have some of those wonderful consultations. This is from the preliminary data of SARS. There have been some uptake on the reliefs taken, but as we saw with the first questionnaire on the poll on the employment tax incentive, a lot of people have not made full use of that. So it's important that we look at all of these things going forward. So I'll leave the presentation now, and Kabashni will carry on, and then we'll come back to some of these questions that you've raised at the end.
Good afternoon, everyone. Thank you for joining us today. And thank you, Paul, for that enticing session on the current tax season as well as the COVID tax relief. Today, I'm going to be talking to you about a topic that's not frequently discussed in tax presentations, and that's corporate restructures and transfer pricing. We're going to run a quick poll just to see how many of you have actually been involved in corporate restructures. You can just click yes or no. So it looks like the majority of you haven't been involved in corporate restructures, which is what we anticipated. And that's why for today's session, we're really looking at, okay, so the final votes is 65% haven't been involved and 35% of you have been. So the purpose really of today's session is to look at corporate restructures and the fact that, to look at corporate restructures and the fact that they can apply to any company, so not just large multinationals or large groups, but also that it can apply to small to medium-sized businesses. And so basically understanding what a corporate restructure is quite important. Corporate restructures really is taking a snapshot of your current structure and trying to make it more versatile, more practical, more efficient, both from a business and a tax perspective. So for example, if you had one company doing multiple activities and you wanted to diversify those activities, so let's take a simple example. You might have set up your company many years ago with the trading activity, and over the years you took a lot of the profits and invested it in fixed property. You now want to diversify those activities because as we're currently facing COVID, for example, a lot of businesses are going into liquidation. And if you had that property sitting in that company, you would then put that property at risk of being attacked by creditors and that. So you might want to actually use a corporate restructure to diversify your activities. And how would we really do that? We would basically sell the property out of your company into a separate company so that there's some legal protection. However, as we all know, once you dispose of a property or dispose of any asset for that matter, you would face capital gains tax. And capital gains tax can become quite expensive depending on the value of the property since you actually purchased it. So a corporate restructure provision, which we're just going to touch base on just now, will assist you in actually rolling over the relief, rolling over the capital gains tax that you would normally pay. Or let's take a scenario where you've got multiple companies that are doing similar activities. So let's say, for example, you have multiple entities you're involved in manufacturing, and all of these entities are manufacturing different parts or are possibly manufacturing similar products, and you're now looking to actually reduce the number of entities you have. This will help you both in eliminating your administrative costs, so you would have less SIPC fees to pay, less financial statements to draft, bookkeeping fees would be eliminated, There's a lot of unnecessary costs involved in having a complex structure. So you could actually look to streamline your structure. And how do you do this without incurring capital gains tax? Again, the corporate restructure provisions would assist you in doing that. So sections 1 to 47 of the Income Tax Act allow for you to actually defer capital gains tax and recoupments. The VAT Act and the Security Transfer Act, as well as the Transfer Duty Act, have their own specific exemptions, and these link back to the corporate restructure provisions in the Income Tax Act. So effectively, these are not full exemptions, but they do allow you to roll over any taxes that might have arisen when you actually restructured your business. So a lot of these provisions rely on what we call a tax group. And so for the purpose of today's session, we just want to make you understand what a tax group is. So a tax group is basically a group where, or let's just firstly disregard what a common misconception of a tax group is. So a tax group is not where you have a single shareholder or common shareholders having a controlling interest in various companies, such as this structure. This might be an accounting group structure, but not a tax group. So what is a tax group? A tax group is basically where you have a minimum shareholding of 70%. The shareholder has to be a company, so you cannot have a trust as a shareholder. So a company has to have at least a 70% stake in another company. So in this demonstration, you'll see on Holdco and Subco 2, you do have a tax group, whereas on Holdco and Subco 1, you don't have a tax group. There are further limitations on this tax group definition, and that's where you've got public benefit organizations, or you have a recreational club or a foreign company. Those entities don't qualify to be part of a tax group. You have to bear in mind, though, that if you do have a controlled foreign company, you are able to use the restructure provisions. There are specific rules for controlled foreign companies. And a controlled foreign company is basically any company where the shareholding is at least a 50% South African resident held. So the first type of restructure we want to basically bring to your attention today is Section 42. Section 42 looks at asset for share transactions. And here we're going to address what is known as the dividend trap in looking at this type of restructure. So firstly, what kind of a structure do we have here? We've got two trusts, effectively Trust 1 and Trust 2, holding a 50-50 shareholding in TradeCo. There is dividends tax here that's payable at 20% on any dividends up to the trust from the TradeCo. So if you are incurring the company tax rate plus dividends tax, you're paying an effective rate of 42.4% on all profits effectively made by your TradeCo. So what's wrong with the structure? Basically, you're paying a lot of taxes in order to utilize any of the profits of TradeCo. So let's take an example where TrustCo 1 wants to purchase its own fixed property. It has to now declare dividends out of TradeCo, pay this effective 42.4% tax on that profit. So basically, there's a lot of taxes that's being unnecessarily spent. Trust 1 wants to obviously invest as much as they can without having to pay all of these taxes. And so an easy way to try and restructure is to look at introducing an investment company for each of these trusts. We also have a further problem in this example in that TradeCo has a property it wants to actually diversify from its trading activities. So in undertaking this type of restructure, we do it in two parts. So firstly, part 1 is you'd introduce a holding company. A holding company would basically be used to create a tax group. And to do this, we'd use an asset for share transaction. So basically, Trust 1 and Trust 2 would sell their shares in TradeCo to the holding company. And in exchange, the holding company would issue shares to Trust 1 and Trust 2. Effectively, what's happened in this step is Trust 1 and Trust 2 still hold a 50% stake indirectly now in TradeCo as opposed to directly as it was in the previous structure. Any dividends being paid from the TradeCo into Holdco would now be free of dividends tax. This does allow you to now transfer the property out of TradeCo into Holdco, or alternatively, Holdco could actually set up another company, which it would then use as the property company. and then transfer the property from TradeCo directly into that property company. And then you'd have a structure with the holdco and two subsidiaries, one with trading activities and the other with property investing activities. The second step and the more crucial step in this transaction to effectively reduce your dividend trap is for each of the trusts to have their own investment companies. And here we would introduce Investco 1 and Investco 2. And this we would do in terms of an asset for share transaction again. So we would basically swap the shares from Trust 1 and Trust 2 from holdco into each trust's investment company. So Investco 1 would basically purchase the 50% shareholding of Trust 1 and now issue additional shares to Trust 1, resulting in Trust 1 owning 100% of Investco 1 and 50% of holdco. Trust 2 would do the exact same thing, holding 100% in Investco 2 and a 50% shareholding in holdco. As you can see, the indirect shareholding of Trust 1 and Trust 2 in TradeCo has remained unchanged at an effective 50-50 basis. However, in this structure, all dividends paid by TradeCo to holdco would be free of dividends tax, and this is because of the resident company exemption for dividends paid from one South African resident company to another. So you'd have no dividends tax from TradeCo to holdco, and again, no dividends tax when you paid any dividends from holdco into Investco 1 or Investco 2. These dividends would then be able to be invested by the Trust 1 at the Investco 1 level, and the property could be either purchased in Investco 1, or if Investco 1 wished, it could have a further subsidiary at that level, which could then house that property. So as you can see, this structure does allow you to do a lot of different types of investing and structuring, and would be able to retain the dividends from the trading company for as long as you wished until you actually wanted to pay that out to the beneficiaries of Trust 1, at which time you would then have a dividends tax arising. There is quite important anti-avoidance rules to remember. So entering into a cooperatory structure isn't difficult. However, there are a lot of timing issues with each provision. So most of these provisions carry an 18-month timing requirement where you're not allowed to dispose of any assets that you acquire in terms of a restructure, or you can't dispose of any shares that you acquired in terms of a restructure. There are additional timing issues as well, but the main timing issues are contained in each section. There are also other deemed CGT issues with regards to dividend stripping. So in our previous example, if you took all of the dividends out of the TradeCo and then decided to disinvest from the trading company, you'd then be subjected to a deemed capital gain on some of those dividends. There's also interest deductibility issues. So where you've got loans that arose as a result of a cooperatory structure, there may be a limitation on the amount of interest that you're allowed to deduct. So value shifting anti-avoidance rules really looks at whether or not there are connected persons that are transacting at arm's length, and whether or not there is a disposal for CGT purposes, as it could be deemed capital gains tax that would arise. So cooperatory structures can be very versatile. You are able to use different restructures to do different things. So for example, if at any point you wanted to eliminate TradeCo, you could use the Section 47, which is a liquidation transaction, to eliminate TradeCo. This would be done free of capital gains tax or any recoupments, assuming there's some allowance assets, some PPE that's sitting in TradeCo. You also would be able to move assets freely between TradeCo and any other fellow subsidiaries that you wish to set up, or to the holdco in terms of an intergroup transaction. However, that provision has a specific 6-year lock-in period, so you can't cease to form part of the same group. So if there is these types of structures that you're interested in doing or interested in engaging us with on, you can actually contact us and we can assist you in terms of looking at your current structure and how we can make it more practical and more efficient for you. So the next topic we're going to look at today is the transfer pricing. And just to get an understanding of how many people on this group are actually doing transfer pricing or have companies that require transfer pricing, we're going to run a quick poll. Transfer pricing is a topic that was recently mentioned in the special budget by the Minister of Finance as one of the risk areas that SARS is currently going to be looking at. And this is obviously an area that SARS has spent a lot of money on in terms of engaging in additional staff. So the audit division on transfer pricing has been expanded quite significantly. So this is an area we thought we might spend a little bit of time just explaining what it is and why it affects you and how would you become tax compliant. So the majority of you don't have transfer pricing policies in place. Okay, so this might be because maybe you don't require transfer pricing for your company, or maybe you're not aware that you do, and hopefully today's session will help you determine whether or not you should have a transfer pricing policy. So as I said, the task for today is really to answer 3 questions, and that's what is transfer pricing, how does it affect my business, and how do I become tax compliant? So the OECD and the United Nations effectively came up with what they call the Action Plan on Base Erosion Profit Shifting, and transfer pricing really is just part of that action plan. And base erosion profit shifting, for those of you that are not aware, is effectively the artificial shifting of profits by multinationals from one country to another, whereby they effectively are reducing or eroding the tax base of one country in an effort to shift profits into low tax jurisdictions and lower the overall level of tax obligations in the low tax jurisdictions. So transfer pricing is actions 8 to 10 of the BEPS action plans, as well as action 13, which specifically looks at documentation. There were quite a few cases recently that involved transfer pricing with big companies such as Google, Starbucks, and Apple, where these companies were found guilty of actually transfer pricing and effectively reducing their group taxes significantly by shifting profits. So what is transfer pricing? As I said, it's the artificial shifting of profits. In this picture, you'll see that there's a head office, or the holding company is basically located in Mauritius, with operations in India, South Africa, Australia, and the US. And there are multiple transactions being conducted between the head office and the subsidiaries, and between the subsidiaries themselves. So what types of transactions are we looking at? The transactions that would affect these transfer pricing, so the transactions that affect revenue authorities are manufacturing. So where you have a group that's doing a lot of manufacturing activities, perhaps there are several subsidiaries doing different parts of the value chain. The revenue authority would basically be looking at which country is attributing the most value and whether or not that country is being properly compensated. So in terms of manufacturing, this is a very high risk level. And in terms of distribution arrangements are whereby there's probably one company that's purchasing the goods and products and distributing it to various countries using different subsidiaries that it sets up in each area. There's also procurement or other engineering type services that may be rendered. And this transaction would look at whether or not the employees that are being seconded to the different countries, whether they are able to transfer their prices at arm's length. Sorry, there just seems to be some writing popping up on my screen. The other transactions that revenue authorities would be looking at is intergroup loans. So intergroup loans are obviously looking at thin capitalization. Has the company been too thinly capitalized? So is the level of debt excessive? And whether or not the interest rate and the terms and conditions of those loans are at arm's length. There's also royalty transactions. So often multinationals will use royalty transactions to strip a lot of the profits out of countries with high tax rates. And so this is another risk area that revenue authorities would be looking at. We've always had Section 31 in our Income Tax Act, which required us to transact at arm's length, but there were never any specific reporting requirements. So when it came to transfer pricing, you weren't mandated to have a transfer pricing policy. However, on the 23rd of December 2016, a government gazette was issued whereby it became compulsory for you to submit your transfer pricing policy with your tax return. So for years of assessment commencing 1 October 2016, you have to now submit a transfer pricing policy with your tax return. For most clients that have a Feb 2018 year end, this would be the first period in which you would have to submit such a return. Only companies with potentially affected transactions of over 100 million would be required to submit this policy. And potentially affected transactions looks at cross-border connected person transactions. I threw in a little bit here on country-by-country reporting. We're not going to go into detail on that, but it's just so you understand that there is also a threshold of 10 billion group turnover. And if that threshold is reached, the parent entity of that multinational group would be liable to submit a country-by-country return, which is effectively a separate return that would accompany your tax return for that year, disclosing the transactions on a country-by-country basis. And if you are part of a group where you're not the parent company, you're still required to send a letter to SARS advising them of who the parent company is and the fact that they will be compiling this report. In terms of a transfer pricing policy and what it entails, the master file is the policy. The master file is the file that's been submitted by the parent company, and the local file will be the file that's been created for each country or each tax jurisdiction. The full transfer pricing policy entails detailing the background of your client's business, your business structure, strategy, regulatory environment, describing a detailed description of your transactions, bearing in mind that any transaction over 5 million, there's specific documentation that's required to be held, an organogram of all staff skills and experience, functional and risk analysis will have to be performed for each type of transaction, and then a benchmarking study will have to be performed for all the potentially affected transactions. We at PKF use Thomson Reuters and Royalty Stats software to assist in compiling these policies. It does take quite a bit of time actually to do these documents, so it is important that you start the process as early as possible. What happens if you don't comply? So if you are subject to a transfer pricing audit and SARS determines that your prices are not at arm's length, they will raise an adjustment in terms of Section 31, and the adjustment effectively will increase your taxable income, which means there will be a significant tax bill that will come with it. And of course, as soon as there's additional tax payable, there's penalties and interest that will arise. If there is a thin cap adjustment, so where there's a loan and there's part of that interest that's being disallowed a deduction, you'd again have an increase in taxable income. You'd also have a deemed dividend that would arise, as well as penalties and interest. There is one thing to bear in mind, that if SARS does raise an assessment for transfer pricing, the normal dispute rules will apply, which means you only have 30 days to dispute that assessment. However, if you don't have a transfer pricing policy in place, it's very difficult to actually dispute that assessment, and trying to get a transfer pricing policy done in 30 days is very close to impossible. So we would therefore recommend that you start your transfer pricing policy if you do fall within the category of having 100 million rand worth of transactions, that you do start with your transfer pricing policy, because the general turnaround time for the documentation of doing a transfer pricing policy is approximately 1 to 3 months. So if you do want to do this at the moment, you should really start. SARS are issuing a lot of letters at present with regards to transfer pricing queries. And as it was mentioned by the Minister in his budget speech that they will be looking at this much closer, we would recommend that you actually start the process sooner rather than later. Thank you everyone for listening. That's all we have on corporate restructures and transfer pricing. We're now going to move over onto the question and answer session.
Well, we're at the end of our hour, and so really it's just to thank everybody for their attendance on this, our first webinar. We will circulate the slides. We will also circulate a recording, and there will be a feedback questionnaire that will go out so that it can give us an idea on how to proceed with the next webinar that we will host. So we chose two sets of topics that we thought were of interest. We will look forward to feedback from the questionnaire so we can design the next webinar to meet your thoughts and processes in that regard. So I hope that you've enjoyed this afternoon and that you will enjoy seeing the slides and the recording should you wish to listen again. Thank you all.
Thank you, everyone.